When talking about trading, the conversation usually revolves around the trading setup. After all, people want to find the trading opportunity, enter the trade, and just reap the rewards. But in order to reap any reward in trading, there's one key element that gets overlooked by many people, and that's how are you going to take your trading profit? That should be obvious, but I've seen many times where people, they're in a trade and they have no idea when or where they should exit. Now this poses obvious dangers such as taking a large loss or watching your profits evaporate. Now hopefully you're well versed on the topic of risk in trading as it pertains to your account. When you enter a trade, the possibility of it going against you is always there, whether it's just to retrace some of your profits or put you in a negative position. Now if you've not taken the time to learn about position sizing, this move against you that puts you in the negative can actually be enough to trigger a margin call. For me and so many other traders, the stop placement will define the position size. So here's an example using Forex as the instrument. Let's say your account balance is $10,000. You've decided you're going to risk 1% per trade. That would give you $100 risk per trade. So now, whenever that setup occurs, my maximum risk on any one trade is $100, which just means my allowable loss is $100. My trading profit, though, that's variable, and it's dependent on the conditions of the market and my exit strategy. So let's say that my setup is just a pullback. Now this particular zone is 25 pips plus 5 pips wiggle room, which would give me a stop of 30 pips. Now I use this zone bottom because if it's violated, my premise for that trade's not valid. A quick calculation shows that I can trade $3 a pip, which is 3 mini lots, when placing my stop in a location that will show me if my entry is a little early. Now, I've got my setup, and I know exactly where I'll exit to protect my trading account from taking a beating if I'm wrong. Now, here's the point. A stop order, it sits in the market like a limit order just waiting to get triggered. But once it's triggered, it acts like a market order where you actually get filled at the best possible price, which can mean slippage. Now, Forex is a market that's really easy to dial in your position size because of the various lot sizes available at many brokers. Almost no trade is off limits due to your stop size, but you might want to consider what type of trade you're taking. As a rule of thumb, swing or position trading will generally have a larger stop than a scalping type of trading. Now, in my example, I took an even more conservative position size, which is less than 1%, by only risking $90 because I rounded down. So if I'm prepared to lose $90, should I not aim to make at least that amount in a trade? How would I go about giving myself a chance to make at least as much as I've risked? Now this is where your in-profit exit comes into play. Now this is where things get a little tricky. I want to limit my loss, so I have a hard target for an account protecting exit, but I want to make as much money as I can on this trade. So does it make sense to have a hard target for profit taking? Would I not be cutting a trade short? Picture this. You're riding a trade high and your initial risk of $90. Your trade is now up $270. So adverse news comes out and your profits now drop down to $180. You've lost $90 from your screen. So your emotions take over and you sit on that trade waiting for that market to rise again, but it keeps dropping. Now, more people start to bail on their longs, driving the price further against you. And finally, you take the exit at plus $90. Wash, rinse, repeat, because this is the course that many people take in their trading. Now ask yourself if you're able to be objective and exit your trade during an adverse reaction. Most people can't, and that's where hard targets for your profits come into play. Now your targets may not always be hit, but if you have an exit plan during the negative parts of the trade, you might still gain a profit. So if we agree that we'd like to make more than we're going to lose, well, what's the best way to go about it? Some will argue that scaling out takes the emotion out of the equation because you've banked some profits and you've lessened the remaining risk. You can just leave the trade running now while trailing your stop for bigger gains. But others will say that scaling out is pointless because a loss early on in the trade would usually be a full position loss. Your profits, though, will not be on the full position size because you took out partial. Now, they're both right. And really all that matters is what you are comfortable with and what you will do on a consistent basis. So how do you exit? In the next few posts and the videos, I'm going to cover some ways that you can exit your trades. And hopefully this will help you from holding on long after all the signs have pointed